Welcome back. After that mammoth session, we are going to see if we can anchor some of the stuff we spoke about. And we're joined by Andrew Dreschner from Mercury Wealth. Hi Andrew, thank you for coming and joining the show again.
Hi Kerry, glad to be here.
Okay, now you saw what we did in the earlier section. We've been talking about tactical and strategic allocation.
Yes.
We discussed some reasons why we thought strategic allocation might be the way. What's your thoughts about tactical and strategic allocation for clients' portfolios?
Well, I think, there've been various studies which shown that, 85 to 90% of return actually comes from strategic asset allocation. It's having your set allocation of investments and leaving those in place. I mean, it's proven very difficult for anyone to, pick what's going to be next year's winner and try and change, where their investments are held. It's virtually impossible, I think, for anyone to do it over a long period of time.
Yeah, which is why fund managers earn a lot of money but don't last very long.
Yes, it tends to be the case. So most of them have really a lot of trouble beating the index in terms of the average return. So.
I remember a study in America, and they studied 90%. They studied the fund managers' performance of their personal portfolios, and only less than 5% outperformed the index.
That's reassuring, isn't it, for clients?
They said it was because they were taking riskier investments in their own portfolios. So. Okay, so you run a strategic model for your clients?
Yes, we do.
Okay, can you just, I've been through it all, but can you explain it again from an advisor's perspective, how somebody might actually use that?
Yeah, sure. What we do is we sit down with the client, we work out an asset allocation in terms of how much is invested in each asset class, and essentially what we do is rebalance the portfolio on a regular basis. So that may be annually, just to ensure that they remain within that asset allocation.
And most funds don't charge for a rebalance?
No, they don't, no.
Okay, and some funds automatically rebalance?
Yeah, they do. So you can, and you have different options. So you may do it annually, you may do it quarterly. It just depends. It depends on the size of the client's portfolio.
So quarterly, is that probably a bit often? Does it cause tax problems?
Yes, it does. You really don't need to rebalance it on a quarterly basis, in my opinion. So.
And the other thing is that markets rarely move that quickly. They tend to be a bit slow, don't they?
Well, that's right. I mean, things have been more volatile, of course, over the last couple of years. But historically, markets don't move that much on a sort of quarterly basis.
Andrew, you said that the strategic approach to investing yields the better results. How much of that is attributed to the rebalance, where we actually sell high and buy low?
I think it makes a big difference in terms of the rebalance. Because, by human nature, if you see negative news or what have you, of course, you're tempted to sell assets which may have decreased in value. And that's probably the worst possible time to actually do it. Whereas if you're rebalancing, it's forcing you to actually buy the assets when the prices have come down in value, and over the longer term you'll be better off.
It's only on the periphery though, sadly, isn't it? It's a shame we couldn't do that for the whole portfolio.
That's right, that's true.
Yeah. Okay, so what I'm saying there is we're only changing the little differences rather than the whole portfolio.
Yeah, that's right. So it's not 100% rebalance every sort of 1 year or what have you.
Okay, now can you give me some examples of how a strategic approach to investing actually works to prevent people from making the sort of mistakes that the amygdala causes them to make?
Well, I guess a perfect example is in what we've experienced back from 2008 when the markets really decreased in value. It's very tempting for clients at the time to sell because they think, I can't handle any more losses, I can't have another negative return.
That's their lizard brain working, yeah.
Exactly. And of course what tends to happen is the markets do come back, and they come back very quickly, and it's very difficult to time it and try and know when to put the money back in. If you sell, you're crystallising a loss, of course, and you tend to miss the rebound.
Yes. So you've set a strategic approach for a client, and then maybe a client's rung up and said, I want to move, and you've reminded them of the approach they set in the cool light of day with their prefrontal cortex, their thinking brain.
Well, that's right. That's what we're here for, as such. It's an emotional time when clients see things in the newspapers, or because negative news, of course, sells. And of course, when the markets are performing badly, clients might start to get nervous. But that's when you have to remind them, this is the approach we've taken. It does work over the long term. And the worst thing you could possibly do is change that approach now.
Have you a story for us where it actually worked for somebody?
Yeah, sure. I had a client who was invested in a balanced portfolio back in 2008. They actually had the value of their investments decreased by around that sort of 20% mark in 1 year when we had that terrible year in the markets. They were very nervous at that time. They came in, we had a chat. We explained how the strategic asset allocation worked, and they were better to hold off in terms of selling off those growth assets like the shares and what have you, which the client agreed to do. And now their portfolio has actually reached that same value again, so they've made their money back as such. They were still generating enough income to pay themselves a pension, which is of course the most important consideration.
Yes, I guess that volatile markets are scary for people in pension mode.
Yeah, they are, particularly so.
Yeah. And I guess that a different asset allocation is important for people of this type.
Well, that's right. I think once you reach, say, a certain stage in your life, you need to sit down and work out how much income you need to generate, and then sort of rebalance your portfolio accordingly. So you may have more conservative assets, more invested in shares or cash or fixed interest, or even some annuity type products where you know you've got a certainty of income there.
The final thing I like about a strategic approach is it does sort of force you to pick all asset types. Even though, I mean, I don't like cash at all in a portfolio, truthfully.
Yep.
And I'm not incredibly keen on fixed interest.
Yep.
But nevertheless, if you're using a strategic approach, you have a little bit of them so that you can ride up the ups and downs. And that balance across a portfolio is generally beneficial, do you think?
No, it definitely is. I mean, your fixed interest would have been one of the better performers over the last sort of couple of years. So if you'd taken that approach where you had no fixed interest, your portfolio definitely would have suffered. So it's good to have that mix, and whether that be alternative asset class as well, or infrastructure assets, or what have you.
Thank you for joining us, Andrew. Again, it's a pleasure to have you back.
Okay, thanks, Gary.
Okay, look, I hope you enjoyed that and it made it a little bit more real. I understand the first session could have been a little bit technical. What we've discussed is anchoring a portfolio that's determined in the cold light of day and sticking to it irrespective of what happens. We'll see you after the break.